Hi everyone, welcome back to the chapter 4. Um, it's We're gonna talk about the inventory this time. So for this chapter, I'm gonna divide into the videos because the content is a lot. I'm gonna divide in 4 videos. The first one video is gonna cover objective 1, 2, which talk about the basic concept of inventory and how do we presenting cost of goods sold and inventory on the financial statements. And second video, we're going to cover determinants of cost of goods sold, and then we introduce you the four inventory cost of goods sold method. So it's very important. It's paved the foundation of the rest of the chapter. And third video, we're going to detail about how to record inventory transactions. We want to compare perpetual system with a periodical system. And then that's why the learning objective 8 is actually promoted to right next to the learning objective 5, because we needed to compare these two systems together to understand what's the difference between these two systems. How does companies nowadays using perpetual or periodic. And then the last video is going to cover the rest of the topics, learning objective 6, 7, and 9. And the 6 is talk about lower, comparing to the cost versus the fair value, and how do we choose which one is better. And then the major message from that video is gonna talk to you about what is the conservatism in terms of accounting. And then learning objective 7 and 9, just miscellaneous items that we need to know more about uh, inventory. And then especially learning objective 9 is interesting when you go to the higher level of the classes, or um, it's more introduce earning management using inventory accounts, such as how do we deal with inventory errors. Okay, so without further ado of the overview, and then I would like to share my screen and start to talk about the inventory. Okay. Okay, so first we want to understand the inventory flow from difference between the manufacturing firm and the merchandising firms. And so at least both of these firms are reporting inventory as an asset on the balance sheet. Okay. So what is inventory? Inventory means that it including the items that a company intends to for sale in the ordinary course of business. So no matter you are manufacturing like Lenovo, or you are merchandising company such as Amazon. So these firms are intended to hold something or items or products that intended for sale to the customer to generating revenue in the ordinary course of a business. Okay. So inventory also including the items or products that are not yet finished goods, especially we talk about manufacturing firm in details later. And it's generally reported as a current asset because the turnover rate of this kind of asset from beginning to the end is usually less than 1 year. And we talk about that more in the learning objective 7. And the cost of goods sold is okay. So the second most important thing about this chapter, besides we understand what is inventory, is the cost of goods sold. So these words can be expanded into a sentence, is that the cost of those goods that are sold. And then, so in short, we call it cost of goods sold. It's a professional word for counting the expenses, inventory expenses that sold to the customer. So you need to remember the name of this account called cost of goods sold. It's the cost of inventory sold, okay? And it's reported as expenses in the income statements. Okay, so now we wanted to take a closer look at uh, how does that manufacturing firm versus merchandising firm differently from each other, how do they counting inventory? So inventory for manufacturing firm has 3 parts. One called raw material, another one is work in process and finished goods. how do we understanding the relationship between these three parts is that if you are a manufacturing firm, that means your purpose is not only to sell the finished goods, it's also to assembling, to produce the finished goods, such as Lenovo, they actually producing their own majorly components, or the furniture firm, instead of furniture wholesale firm or retail firm, that those firms are actually got the lumbers and cut them and then molding them and then paint them and then design them and then all together and then become a finished good. So, and then another good one is IKEA, right? IKEA, we know we are even be part of the assembling process, but the material design and the display and the sell is all whole chain. And then, so this kind of firm is, IKEA kind of firm is hard to define whether it's a manufacturing or it's merchandising. I think they are both. Okay, so, but you get the idea of a manufacturing firm. Manufacturing firm is using the raw material, assembling and producing and glue and design them and then put together, become a work in progress, means that the product hasn't even finished yet, right? So, because you cannot expecting the product to finish overnight or in 1 second. So there's a products that are still are in the process of to be made, and then there's a products that are finished and put into the warehouse. Okay. On the other hand, merchandising firm is actually much clearer. They are the ones that getting the finished good from a manufacturing firm, and they are the middleman between the customer and the manufacturing firm. And then they are in form of a wholesale, and the retailers allow customers to come to buy product from merchandising firm. And this middleman and charging premium because the services that they're providing to finding different manufacturing firm and assembling them into different section and then charging higher fee for the customers. Okay, so in nutshell, in this, the relevance of this chapter is they all involve touching inventory, right? Okay. So how do the merchandise manufacturing firms such as Intel versus merchandising firms such as Best Buy presenting their inventory? So there will be a section on the balance sheet showing inventory accounts. If this is Intel company's balance sheet, you will see raw material, working in progress, and finished goods. And then if they are also producing and selling merchandising inventories, then the Best Buys will be the one only reporting a one number of $4,864. So this is a difference between the manufacturing firm versus merchandising firm. Okay, so types of company and the flow of inventory cost. So this graph is greatly communicate to us that how does inventory involved in different kind of types of companies. In the manufacturing firms, as you can see, if we can using Intel as example, we have a different raw material, and also we involve direct labor who are the ones assembling them. And then also there's overhead such as lighting, such as renting, such as administrative employees, they are the overhead. So if you have a problem with this methodology, this is not the key of this chapter. At the same time, there's a whole class about how to assign a cost to a product. They call it managerial. That class either called a managerial accounting or cost accounting, depending on different institute. So in the manufacturing company, you will have in touch with a different form of the cost that is pulling into one product called work in progress because it hasn't finished yet. And once it's assembled and finished, it will become a finished goods. And these finished products will become merchandise company's inventory, which is a current chapter. This chapter we're majorly dealing with the merchandise company because as I mentioned, the manufacturer company's costing process, inventory process will be a whole new different class. And then the last one, which is we actually talk about the selling process, which is chapter 5, is talking about how did the end user purchase the products and how do we record in revenue and accounts receivable. So the inventory will be sold to the end users, right? And then they start using the products. Okay. And service companies are providing related services for the end user. And this we're going to talk about maybe in the intermediate one, how do we record the service revenue? Okay. Okay, the key point here is that service company record a revenue when they're providing service to the customer. That has been trained to talk about from chapter 1 to chapter 3, right? And the merchandising and the manufacturing company record revenue when selling the inventory to the customer. So no matter you are a manufacturing company or you are a merchandising company, your end goal of making money is to sell to your own customer. Merchandising companies sell to us. We as retailers, right? We are the ones who buying stuff individually. And the manufacturing firm will sell their customer is actually merchandising companies, right? Okay. Okay, let's do a concept check. Which of the following inventory accounts consist of items for which the manufacturing process is completed? In other words, out of all this, which one is considered by the manufacturing firm that is completed? Okay, so we are still at the production phase of the manufacturing and it's considered completed. So then we should choose D, right? Because finished goods, raw material inventory is the cost of the components will become finished goods. Work in progress inventory consists of products that are not yet completed. And the cost of goods sold is not an inventory account, but representing cost of inventory sold during the period. Okay. Objective 2. We wanted to understand how the cost of goods sold is reported into a multi-step income statement. And we will talk about the detail of what is a multi-step income statement. Okay, the relationship between the inventory and the cost of goods sold is actually a little bit complex than what you think. The reason is, as we talked about before, asset is always has a beginning inventory. Since the inventory is asset, therefore they definitely have an inventory beginning balances, right? So let's say beginning inventory, which is a beginning balance of the inventory account, has $20,000 balance, and then we purchased during the year about 90,000, which is considered the asset increase as well. And then there's a concept that is we have a beginning of 20,000 and we're adding 90,000 in there. That means that we total available for sale is 110,000, right? Okay, very good. And then what happened to this total inventory available for sale? There's only two possibilities. Either you sold it or you didn't sell it. For the portion that you have not sold, it will be left over and be reported again on the balance sheet as ending inventory for the next period, right? So it's called the ending inventory asset in the balance for the next period. The portion that you sold, the inventory you sold, and that is actually cost of goods sold, and it will be reported as expenses in the income statement. Okay, so therefore there's a four component: beginning inventory plus purchases, right? And then you will have a total of total inventory available, and then this total available inventory will be separated into two possibilities. The sold one we call the cost of goods sold. The one didn't sold we call the ending inventory. Okay, this we have already touched on kind of in the supplies, adjusting entries. Okay. So in nutshell, inventory is a current asset reported in the balance sheet and representing the cost of inventory not yet sold. Not yet sold means didn't sold at the end of period. And cost of goods sold is an expense reported in the income statement and it represents the cost of the inventory not sold already. Okay, cost of goods sold is reported in the income statement, yes. Reported in the balance sheet, no. As a current asset, no. A cost of The cost of inventory on hand at the end of period. No, this is ending inventory. So the correct choice is A, right? Okay, cost of sold is an expense account reported in income statement. Brilliant. Okay, so now we are introducing what is the multiple step income statement. Okay, the benefit, why do we, what is multiple step? Multiple step is to expanding how did we get the net income number, okay? By showing the investors how many steps there is from revenue arriving at net income, okay? And then why do we want to show that? Before I introduce you what it is, why we should want to show that? Because if you walk through investor from the revenue and then all kind of different costs, ending at a net income, the investors are more informative, more informed. Based on how you segregating the section of your communication, and the investors can use those information to predict the future income, right? Future profitability. Okay, hence, let's look at the Best Buy example. This is the Best Buy's multi-step income statement for January 31st, 2017. Their total revenue net of the return and allowances and discount, which we learned from chapter 5, is this $39,000, and the cost of goods sold is $29,963. So therefore, the first thing you knock down from the, you minus from the revenue is cost of goods sold, and you arriving the gross profits, okay? And gross profit, in another word, is to look at 100% from your main business of operation, excluding the hardcore cost of goods sold. How much is your gross profit? And then you are considering the selling, general, and administrative expenses, such as advertising, salaries, rent, utilities, supplies, depreciation, and other operating expenses, those miscellaneous expenses that supporting your operation. Okay, after you subtracting this, we call it SG&A expenses from gross profit, you arrive at operating income. And in this pink letters I wrote is that investors look at this number, they are relying on this number to predict the future profitability of your business. Okay, that means this called the main line of operation is repeatable, is things that I can use to learn from future, learn from the past for the future. And then you will see that there are other kind of income or expenses. Remember, we also know that when you hold a note, you can generating notes receivables, incomes, such as if you gain for selling the warehouse, that is none of your main business line, that will also generate income, right? And then you invest in other people's securities. For example, you buy a share from Tesla or Apple's, you also have investment income. And also at the same time, you can borrow money from other people that will generating interest expenses, right? So all these income expenses is miscellaneous outside of your main line of business. And then we also calculating on its own section and arriving income before income taxes by adding or subtracting the other income versus expenses, and then from operating income to arriving another income item called income before income taxes. This number will not usually used to predict the future because the items inside of this section may be repeatable, maybe not repeatable, right? Hence that we call it, we usually only use the operating income to predict future profitability. And after we subtracting income taxes for the corporation, right? Then we can arrive at net income, this number. So by doing this, as you can see, that where every blue text is actually highlighting how many steps there needs to get this correct number. Okay, very good. So multi-level of profits, right? This is the main line of the sales. And this is the main line after consider SG&A. And this is other kind of miscellaneous activity generating money. And this is ending after considering income tax impact. Okay. So key point is a multi-step income statement reports multiple levels of profitability. Gross profit equals the net revenue or net sales minus cost of goods sold. That's the hardcore one, right? And then operating income equals the gross profit minus operating expenses, such as you will have to use gross profit minus SG&A, selling, advertising, and administrative expenses. And then we arrive at income before income taxes equals operating income plus non-operative net revenue and minus the non-operative expenses. So in another word, if you have too many SG&A expenses, your gross profit drop down to the operating income will be drastically different, right? For example, if you have a $9,000 as a gross profit, and then you only, exactly like this example, you only left with 1,854, then you know you are very big. The operation is actually inefficient because you have too much SG&A expenses. And the income before income taxes actually give you information that besides what I was doing on daily basis as my main business line, is there anything that is helping me make money or cost me money, right? So non-operating revenue minus the non-operating expenses. And last one is the net income equals all revenue minus all expenses. Okay, let's look at a concept check. Which level of your profitability is considered profit from normal operation? Okay, this is a normal operation. Of course, it's gonna be operating income, right? Because you cannot choose a gross profit because it hasn't considered SG&A. SG&A is considered normal operation expenses. You have to subtract those from gross profit. Okay, so the explanation, operating income is measured as the gross profit minus operating expenses. Income before tax and net income, including non-operating items, which are not considered part of normal operation. Okay, so I just want to wrap up the intro right here, and then next video we're gonna talk in detail about learning object 3 and 4, and it's very important to pave the foundation of this chapter. Okay, I see you next video. Thank you.